Thank you very much, everybody, for joining us. We're so pleased you could take the time out. I've got our great panelists here that they've all joined us. I want to thank you first and foremost for taking the time out as well. My name's Noel Tofino. I'll be the host for today. My job is to facilitate the discussion. There's been a lot of work that's gone in the background as well prior to this that we can generate the most amount of value for you about the topic of credit and cash flow. You'll notice here that there's a Q&A box. So if you want to ask questions, please use that. You don't need to wait to the end to ask questions. Feel free to just type and I will pick that up. I will see that straight away. And when appropriate, I'll interject, particularly if any of the panelists are droning on, I'll do my best to interject there. The reason why we thought that credit and cash flow was so important, aside from the obvious in current environment with the impact of COVID, is that in my role as the managing partner for my accounts, in our discussions every day with SMEs, credit and cash flow has been the #1 thing that we all discuss. So I wanted, during those conversations, invariably, I actually throw to, Lachlan from LegalVision, Liam from Slater, Byrne, Beck from PracticeIgnition, and we kind of get all of these solutions out. And I thought, why not just introduce everybody to these solutions, both app solutions and service-based solutions, and then we can have a conversation about it and press forward. So I'm going to get the panelists to introduce themselves. So I'll start with Patrick Coghlan, the CEO of CreditorWatch.
Hey, Noel, thanks for having me. Hi, everyone. Patrick Coghlan, CEO at CreditorWatch. Been there from day one. We're coming up to 10 years in August, actually. So we're a digital credit reporting agency, operate all throughout Australia, used by companies of all sizes, from sole traders all the way up to ASX listed businesses, 50,000 companies across Australia using us on an almost daily basis to access credit reports, monitoring and alerts on their customer base, credit scores, decisioning, that sort of thing. So anything credit reporting, credit management, CreditorWatch is basically tapping into about 50 plus data sources, aggregating all that information so you can make better credit decisions when dealing with customers that you're offering credit terms to.
Thanks, Pat. Lachlan.
Sure, Lachlan McKnight, CEO of LegalVision. So LegalVision's a law firm. We service mainly small, medium businesses and a large volume of them. So our model's a membership model. Nearly all of our clients are members of our LV Connect membership service. And what that means is, we basically have a service where you can call up, book in to speak to a lawyer at any time. There's no additional costs, so we don't charge on hourly rates and so on and so forth. Obviously, right now, we're working with lots of clients who have seen a big drop in top line revenue. So helping a lot of clients dealing with all the kind of issues that are coming out, A, of government stimulus packages, but B, just kind of surviving over the next kind of 6 months. Our model is pretty much online driven. So most of our clients come from, we acquire online. So, legalvision.com.au is the most visited legal services website in Australia. A lot of kind of free content and so on and so forth. So yeah, look, we're here to help, as many small, medium businesses as we can.
Very good. I think we've already received a couple of comments. Heather Causley said, great to see Lachlan in the flesh. They receive the LegalVision emails often, so that's great. Very good. Beck, can you intro?
Hi, Beck Mihalic. I am the head of accounting for APAC for PracticeIgnition. I'm also the director of Business Depot Sydney. So I have 2 roles. Advocate and accountant. For PracticeIgnition, PracticeIgnition is a tech solution that streamlines the engagement process, so you can engage your clients, manage your scope creep, and get paid all electronically. Consistent services, understanding exactly what your responsibilities are and your client's responsibilities, so there's no arguments around services, and making sure that you get paid is hugely important. And
more important now than ever.
Absolutely. And PI fits that really, really nice place where it's part of an accountant's and bookkeeper's business continuity plan, really, because it's services and payments all in one place.
Great. Thank you. Liam.
Hey, everyone. I'm Liam at Slater, Byrne, Recoveries. I run the marketing and sales over at Slater Byrne. Slater Byrne are a commission-based debt recovery firm whereby we only charge upon successful recovery of debts. We generally specialize in helping businesses and companies recover overdue debts, improve cash flow, things like that. And today I'll just be discussing just some helpful tips on what most people can do before it gets to us as well, just so we're prepared for the next few months of the COVID situation.
Nice to have an accent as well amongst all the Aussie,
Just to change it up a little bit.
Yeah, no, I like it. Thanks, Liam. Sam.
Yeah, no accent here. I'm Sam Sfeir from Moula, a regional manager at Moula, I should say. So Moula, for those who don't know, is an online business lender doing unsecured business loans. Predominantly, the purpose of our loans are to assist businesses with cash flow because they are unsecured. We base our assessment on cloud accounting data or banking data. So yeah, the assessments are quite quick. Within 24 hours, we have a decision and are able to lend to businesses and give them timely access to cash.
Very good. Thanks, Sam. So the way that when we were preparing for the content is to break down our engagement with our clients and basically set out a bit of a journey. So we have, pre-engagement with your clients. You have the journey that's during your engagement, which hopefully is a long time with your clients, and then post, which can be, a bit of a gray area as to when an engagement finishes, but I guess post can be considered, when that's kind of coming to an end, which may or may not be because of, debt collection or, disputes and things like that. So I wanted to start at the beginning and looking at the stack and services here, I thought it'd be great to start with Pat and his app CreditorWatch because of what they do with credit checking. So from my experience, Pat, in SME, it's not something that I thought was accessible to businesses our size. I always thought credit checking and that whole vetting process was something that for medium or large enterprises. I think basically until your app came along, I didn't really think it was accessible, but it definitely is something that is accessible and SMEs should be using. All right.
That's right. Yeah. If you're offering terms of any description, even if it's small dollar figures, all the way up to the millions of dollars, you should be running some sort of due diligence or credit check on that particular customer or prospect at that stage, just to get a sense of some basic things like who are they who they say they are, who are the directors, what are their addresses, really basic things that essentially you could go to ASIC and get a company extract to get that information, but then we'll add additional information in there, like have they been taken to court? Has anyone registered a default against them because they haven't made payment? As the director got a history of failed businesses or failing businesses or been involved in Phoenix activity. All those sort of things that come into it. Performing that due diligence is important when the economy is going well. It's extremely imperative at a time like this when we know that there are a lot of businesses out there that are doing it really tough, are on the brink, might be hibernating. Plus we know at disruptive times like this, you often find that there are plenty of organizations or people out there looking to take advantage from a more fraudulent point of view as well. So being able to perform that search that, really until CreditorWatch came along was essentially only utilized by large organization and banks to perform due diligence, usually in a secured sort of manner. Secured finance sort of manner, we've made that available to businesses of all sizes. And, like I said earlier, sole traders all the way up to the biggest companies in Australia.
So it seems like it could be an onerous process. And is that basically what your app has done? Is it streamline that process and make it easy for business? Yeah,
that's right. So the founders of the business, we all came in from outside of credit reporting. So we didn't come in with a preconceived idea of how it should be done because that's how it's been done forever. We came in with a small business background, publishing background, and as a result of that, we focused a lot of our time on technology, user experience, user interface. So we want people to be able to make a decision as quickly as possible. We want people with no sort of background in credit risk or, finance or anything like that. We want to be able to show them black and white. These guys are good. These guys are bad. Really simple. And then the third thing is, that's relevant, especially to this crowd and your market, Noel, is we're the only bureau that integrates with Xero and MYOB. So we can actually automate credit reports plus the ongoing monitoring and alerts of your customers.
It's really good. I think like in the reason why we put together this panel is that there is a lot of other integrations. I think Moula with Sam, PracticeIgnition,
right.
obviously with Beck, integrate seamlessly. So if you kind of put that whole stack together, the data doesn't really drop in or drop out anywhere, and it's all flowing together. So it kind of makes sense, right?
And we're busy. It's easy to forget to run that search, particularly for small and medium business owners. You get a sale and you're frothing to get that sale in, and you often forget about the fact that a sale's not actually a sale until the money's in your bank. So
as a salesperson, I can't believe that.
I always say, salespeople are very, very generally very poor at maths. I'm a salesperson and I'm not good at maths, but when it comes to, working out, commissions or bonuses, all of a sudden we become extremely educated and intelligent around it. So
one of the other attendees is, thankfully, and thanks Renee, I didn't want to think that I was the only one, but they said they've never officially credit checked. They usually went with gut feel, but they didn't really know. It seems like
that's right. The days of handshakes and whatnot are gone. You can still eyeball and you can still get referrals and recommendations, but there's so much information out there that it is really easy to perform that due diligence.
And Ryan as well has lifted his hand and said that's the same. He's gone by gut feel as well. So it seems like this is a thing. So it is, and I was saying before, it's accessible, and I think when I go, credit checking process, it's at a really accessible price. Is it about $40 a month? Or?
Yeah, look, it all depends on how many customers you've got, but it starts at about $40 a month and goes up to obviously, big four banks paying a little bit more than small business. So it's it's very scalable. You can come in at a low rate, and as you grow, or if you want to grow what you're using, it's very easy to do.
I mean, so Ryan, if you haven't credit checked before, all we need to do is not order Uber Eats that one time, and we will have paid for a CreditorWatch subscription. And I think that it's that accessible, right?
That's right. Yeah.
Very good. I think one of the main points that we had that as a key feature that stood out to me at least is. You could actually lodge a credit default. Is that right? Through the platform and the process. It seems like quite a crucial feature, and it would help a lot with communication and a good negotiation point when discussing these kind of things with aging debtors. Debtors that are stressed. So can you elaborate a little bit about that process?
Yeah. So look, you touched on the fact that there's pre-engagement and then engagement and then post-engagement, and CreditorWatch more sits at that pre, but then you've got the monitoring and alerts, which is keeping an eye on your customer. They were good when you first started with them, when they came to you, and all of a sudden they've deteriorated, and we'll send you email alerts when that happens, to give you that ability to react in a timely manner. And then at the end of that is, they're not paying you, you've got the ability to threaten them with a default and then actually register a default. And what that does is puts a black mark against that debtor's credit file. Now, it does seem, it is heavy, it is serious. So it is the sort of thing that you want to say to that person, hey, this is where we're heading. If I don't get a response via email, if you keep avoiding my phone calls, this is the sort of thing that we're going to use. Register that default. That's going to alert all your other suppliers that that you're not paying your bills, which is really important, right? Because there's nothing worse than finding out after you've lost money to a bad debt that your competitor or your mate up the road also got stung by that particular debtor. So it's about that community sort of communication as well, and then obviously leading on to passing that on to a debt collector, which is something no doubt Liam will talk about.
Yeah. So you release an SME risk review every quarter. What is that, and what kind of information do we get?
So we're pulling information in from ASIC, the Australian Business Register, AFSA for bankruptcy data, over 50,000 customers lodging defaults and trade payment information. A huge amount of data coming in, and what we're doing is we're aggregating all of that, and on a quarterly basis releasing what we call our small business risk review. And Australia's done it really tough for sort of 12 months, and that was pre-corona, pre-COVID. We had the the nation sort of slowing down with, you know, New South Wales election and then the federal election, and then we kind of got going again, and then we had bushfires and floods and you know, end of year, and now we're dealing with you know, economic catastrophe. So the most recent release that comes out next week, I can give you a little teaser to it. We'll actually look at how we were doing pre-corona, because really Corona didn't start to bite until, you know, mid-March. But we were seeing,
this is the virus we're talking about, right?
That's right. Yeah, we have plenty of Coronas being
do bite after a while.
through summer, but a different one.
Okay.
Yeah, we were starting to see businesses starting to struggle. You saw in the retail sector in particular, you know, generally you would see administrations happen in sort of January, February, and in restaurant hospitality as well. But we actually saw some big ones fall over in November, December, which is quite unprecedented, because usually that's their money making period. And the fact that they were closing up shop before that showed just how tough it was for, you know, retailers and hospitality in particular.
Yeah.
But then you've seen, you know, agribusiness and whatnot get decimated by the fires and whatnot. So we know that, you know, a default gets registered against a business, they've got a 50% chance of going into administration.
Oh, really? Is that high?
Within 18 months, yeah.
With the on the first default?
Yep.
Wow. Okay.
Yeah. So yeah, it'll be a funny release, because it's not catastrophic in its results, because when you compare it to what's going on now, yeah, it's sort of a soft release.
Yeah, got it. How do the attendees get access to that report?
Jump on to our website, creditorwatch.com.au, and you can subscribe on the blog page. There's heaps of content on there around all the legislative changes around insolvency, bankruptcy, safe harbor, you know, how to get paid as a creditor. But then also, as part of that, we will send out an email with a webinar we'll actually be doing in a few weeks, or next week, around the results, plus the results itself will be in an article published on the blog.
Okay, great. Appreciate that. So if we're moving a little bit further along, so I think we count that as, you know, but there's definitely, you know, importance to keeping an eye on CreditorWatch for anything that happens during engagement, because that will, you'll get alerts through CreditorWatch if anything is to happen to one of your clients during engagement. But moving forward slightly to the actual engagement point, I think it's one of those things that you probably don't think about until something goes bad and you realize how important it is, because the first question that someone that you ask assistance for will be like, can I see the terms of trade, like the engagement letter, the terms of agreement? So Lachlan, thinking about that, and I think I'm trying to think about my accounts in our business. I always remember having engagement letters, but I think how tightly the terms were, how watertight it was, and all has kind of been adjusted as we go, because you learn as you go and things like that. So I wanted to discuss with you the importance of having watertight terms of trade and some of the things that you're seeing there.
Yeah, sure. So look, you know, it's, with any business, particularly service businesses, you know, the terms of trade are absolutely very important. Having said that, and what are the things you need to make sure you've kind of got in those terms of trade? Well, it's the basics really. And what tends to happen, more so than the terms of trade not being drafted properly, is them never being sent. So, you know, that's probably more of a concern. I'd say is like, you know, you're probably servicing a lot of clients who you've kind of forgotten to send anything to.
Yeah.
You know, so the sort of, you know, options that we're sort of seeing in the market now really revolve more around how to make sure that, you know, and if you've got a practice management system and so on and so forth, obviously that works well. But if you're talking to your clients, and this is probably even more important, your clients and how they're interacting with their clients, they don't necessarily have a practice management system. It's all about making sure that you have an automated way in which you're getting those terms out to clients, and on top of that, that you're making sure that clients are confirming their acceptance of those terms. Yeah, because really, to have a binding, you know, contract, you need to have offer, acceptance, consideration, intention to create legal relations, and those are the things that you know, a lot of people are just kind of not bothering with. So, you know, in terms of our business, you know, how do we kind of, you know, deal with this? Is we have a completely automated system where, you know, we'll send a quote, which is all kind of it's a web page quote, and the client will accept those terms with a click and accept button. So we're not getting kind of signed terms and so on and so forth, but we're getting to click, and by clicking that, they're accepting all of our other terms of trade. So our kind of engagement, you know, letter, the obligations that go with that, and so on and so forth. And because the client has actively kind of clicked on that, it's a very low, especially if you're dealing with a large volume of clients. It's a way of doing things which, you know, is there's much less friction than having to, you know, get a signed, even if it's docu-signed, you know, set of terms signed. But if you do that, you know, you've got something that, you know, if you end up going down the debt collection route and you're kind of going to, you know, to a debt collection business, of which there's one here, you know, they'll have something to kind of, you know, to stand on, and they'll have something that they can kind of use. And that's really critical, I think. So making sure that every single client has accepted your terms is probably more important than what those terms actually say, if I'm honest.
You're segueing perfectly to Beck, but I'm doing my best not to jump there too soon. You basically set it up. It's almost like we prepared this pitch for Beck to close. However, there's still other panelists to this, so you can't close just yet, Beck. But one of the things having you on board, Lachlan, I wanted to discuss some of the legalities around the stimulus as well. We're in this at the moment where we're exploring with the grants and all those things available. One of the points we discussed was the grey areas on applying and or calculating eligibility, and you wanted to discuss a point there.
Yeah, sure. I mean, and it's an ever-moving feast, isn't it? So, you know, I think of most interest, at least to most of our clients, has been the JobKeeper package. You know, that's the stimulus measure that's, you know, worth the most, and ultimately is going to probably mean the most businesses are going to survive over the next 6 months or so. But there's been a lot of back and forth around eligibility. So when the government first came out with the kind of the reduction in turnover test, it was a 30% reduction in turnover. There was no indication as to how that was going to be calculated. You know, the ATO has put a lot of flesh around those, you know, the way in which the calculation is done, and it's meant that, you know, you've got to be pretty, you know, especially if you're around the margins, kind of around that 30%, you've got to be pretty careful as to what you're doing. Yeah. So, you know, the year-on-year test originally, you know, was going to be based on the time horizon that you were submitting your business activity statements on. So if you were doing monthly, then it was monthly. If it was going to be quarterly, then if you're doing it quarterly, then it had to be quarterly. That, you know, if you actually then started reading the ATO rules, is not actually the case. So if you're submitting on a quarterly basis, you can still show a monthly decline in your GST in your GST turnover, and if you do that, then you qualify. The other thing we're sort of seeing is the definition of GST turnover to be amended to include revenue being generated from overseas. So, you know, one thing that we've had a lot of clients getting in touch with is like, I'm generating all this revenue overseas. I'm not charging GST on it because it's overseas clients. You know, what's the deal? And if you actually look at the way in which the rules have been drafted, that definition of GST turnover has been amended for the purposes of the JobKeeper program to include revenue coming from overseas. The other thing, you know, you know, we're sort of talking to a lot of clients about is, you know, if you're kind of sitting around that 28%, you know, are the things that you can do to get under it and so on and so forth. And yes, you know, the ATO, the government are very clear that you obviously can't game the system and so on and so forth. But the reality is, if, you know, your business activity statement, you know, GST turnover is done on a cash basis, which a lot of smaller businesses obviously are doing rather than an accruals basis. By just not focusing on cash collection, which again is interesting point given what we're talking about is cash flow on this call, but just not focusing on it for a couple of weeks, you can actually get yourself under that 30%, and that might be worth a lot more to you than the immediate cash flow bump from really focusing on collections for a couple of weeks. Yeah. So it's kind of using a bit of a nuanced approach to the rules and making sure that if you can qualify by doing things, not doing some things that you would ordinarily put more effort into, then then you kind of do that, and that's perfectly acceptable. The ATO is never going to come after you or your clients for that sort of thing. So making sure that your clients, and obviously for a service business, if you're seeing a decline in revenue of over 30% and you are qualifying is super important. In particular, when you look at the leasing code of conduct, which is obviously come out over the last couple of weeks and entitles any business which qualifies for JobKeeper to get a 50% waiver and 50% deferral of the reduction of rent as a proportion of the total reduction in top line revenue. So if you don't qualify for JobKeeper, you don't fall under the leasing code of conduct, and if you do, it can make an absolutely massive difference to cash flow. Yeah, and ultimately the business's likelihood of surviving. So. We've been spending a lot of time on this sort of stuff over the last few weeks. Yeah,
and I'm glad that a lot of your clients are getting those cash flow boosts. And I think what that's kind of one of the key points I wanted to raise in discussion with you was that having a relationship with a law firm such as yourself is invaluable for small business. And I think we're all guilty of this in the past, that we've always viewed, legals as something that is like reactive, and that it's someone that's kind of on the sideline that you don't really need to touch, but when in need, you go and get them. But it's actually something that you can use proactively and be kind of part of your team. And I think that's part of that model that you've been.
Sure, 100%. So, and that's really, our goal as a business is to do two things. And this is not so much from the client perspective, but from what are we building? It's a business that delivers a product value to clients. So we try and productize our services as much as possible, because if you do that, you can obviously then start selling them at a lower cost than if you're kind of reinventing the wheel every time. And the second thing we aim to do is to provide ongoing value to clients. So yes, you're right. Lawyers traditionally have been very reactive, and you go to a lawyer when there's a problem. What we try and do, and that's obviously part of having a membership-based approach, is to provide ongoing value on a weekly, monthly basis. And to do that, you have to be, servicing at a low cost and productizing your services. But if you can do that, in some ways, what we're trying to do is follow some of the model of the way successful accounting practices are run, which is to have that kind of monthly retainer and have that ongoing relationship. And certainly. We love working with accountants because there's so much stuff that people come to lawyers for. And
it sounds like you're setting it up for Beck again.
Yeah, it's stuff that we can't really help them with. We don't really want to help them with. We're not frankly that interested in.
Yes.
But getting that having that relationship with an accountant where you can say, all right, well, these guys can help you. Is very helpful, and if you're aligned in the way that you operate and in the way that you think about delivering value, it's a great way of doing business.
Well, one question from the floor, Lachlan, and if you're able to answer, if you can't, that's okay. Let me know. Our real estate agent has advised 50% waiver, but having to pay back 25% of this in the future. Is this correct?
Okay, so if you qualify for JobKeeper, you've had that 30% drop in top line revenue. Then for the duration of this, pandemic, which, frankly, let's say the next 6 months, your landlord is under the code required effectively to give you a 50% waiver and a 50% deferral. So and that's of the reduction in revenue. So let's say you've had a 30% reduction in revenue, and your rent is $100,000 a month. What they're required to do is give you a $15,000 waiver, so you don't have to pay $15,000 a month for 6 months, and to give you a deferral of $15,000. So what that means is, you'll need to pay that $15,000 back, but it can be paid over a 2-year period, depending on the length of the lease. That doesn't mean that something else can't be negotiated. So the framework of this kind of leasing code is based on, landlords and tenants getting together and negotiating something. So you can negotiate something that's different to that, but the framework is you should get at least a 50% waiver and a 50% deferral of the rent as a proportion of the reduction in top line revenue.
Okay. Heather, if that's hasn't quite, it sounds like it has, but if you need to get in contact, get in contact with us and we can put you in contact with someone to have that.
Sure, 100%. Yeah.
Thank you very much.
Well, sounds like Heather's on our mailing list anyway. So.
Yeah, exactly right. So look, kind of going back a couple points. You said that the delivery and the reception of the engagement letter is almost more important than what's in the terms itself. So I'm going to use that to kind of springboard back to Beck, who is head of accounting at PracticeIgnition. PracticeIgnition does exactly this. I actually can't believe how well he set that up for you. So I'll bring it back to my accounts again. Because we've had pre-PracticeIgnition and post-PracticeIgnition worlds, and again back to what Pat's comments were about the sales people kind of forgetting about engagement letters and those kind of things. Because once someone has said, "Yeah, deal," I'm like, "All right, the job's done." Hand over to ops team and things like that. But the delivery of it is absolutely crucial. So can we talk a little bit about how PracticeIgnition solves that delivery and that friction point, and then helps with this whole credit and cash flow process?
Yeah, absolutely. Look, it's not just salespeople who don't like the engagement.
Yeah, you're right. Thank you.
That's right. It's basically everybody who has to give a service out. Accountants and places that I've been at prior to where I am now, or even the first couple of years at Aptus before we made PI our absolute must use for every single engagement. You go through this process where client comes in, desperately want to get the work done, particularly if they're got something outstanding or they've got some sort of problem, and you just sit down, you get into it straight away on that date. You haven't talked about fee, you haven't talked about the actual service, there's no agreement between you and them and who's going to do what they to supply. And worst part is when these guys actually are already broke and you do all this work, the chance of getting paid just dramatically decreases every single time or every day that you go through with this. So and we're all guilty of it because it's the uncomfortable thing. And accountants especially, we were not at any point taught how to ask for money for our services, which is really, it's shocking.
I think it's a hard thing for a lot of business owners. I think you develop those close relationships with people. It's like asking a friend, I'm not inclined to split a bill, but it's kind of like, I'm not really going to be asking my mates for, $30 or whatever for, half a round. And I can imagine that kind of behavior is similar to business. It's hard to ask for money.
Absolutely, which is a scary concept in itself because we all need it to be able to function and pay our bills and move through life. So PracticeIgnition, it gets rid of all of that because what it does is it takes away the pain point in creating an engagement. So what's the worst part is like actually having to create it from scratch, customize it, pull it through, make sure that it's not missing any important background information. All your T's and C's are consistent, your branding's consistent. These are the pain in the bum parts, and plus actually making it happen. So PI it's an electronic engagement solution. Your templates and all your services are already there with your appropriate fees. Once it's set up, it takes all of 2 minutes to create a proposal for a client. You can do it straight after meeting with them or talking to them, or you can do it with them in the meeting, which is what we do. Not so much now because we're not meeting so much, but prior to this, absolutely, we'd sit down in a meeting with clients and share them. We can actually create them really easily right now when we're in a Zoom meeting. So sending it out, they e-sign it, and comes straight back to you. So within a couple of minutes, you've created your proposal, had it signed off, and it's back to you. Yeah. And PI has the extra feature where the clients can put in their payment details. Yeah. So you've just secured your payment. And that is like, that's amazing. Like how it just takes away all of that friction in the relationship over who's going to get paid what, when, and how.
Sorry, Beck. I was going to jump quickly before we get back onto the direct debit, and I'll come back to you on the direct debit. But I wanted to ask Liam at Slater Byrne in Recoveries, what do you do? What can you do if you're trying to recover with no engagement letter?
Look, there's no doubt that it makes it a little bit more difficult if you don't have engagement terms. The best way around that is, if you don't have anything, is just to get email correspondence with a quotation across. Yeah. You can at least then get a response with an acceptance of terms, an acceptance of the service provided or the product sold. And it just means that it's a lot harder for the debtor to dispute the debt later on. Yeah. That's probably the best option if you don't have terms and conditions, but terms and conditions would be they'd be pretty important for most businesses to have.
So to maximize recovery, terms and conditions is definitely.
Absolutely, yeah. Like they could be in the form of credit applications, quotations, or contracts, but having terms and conditions is obviously number one. Yeah. A close second would be just get an email, get correspondence from the debtor as to what they're requesting, and get it in writing.
Good. So back to you on the PracticeIgnition side. A function that we use as well ourselves is a direct debit feature of PracticeIgnition. So on the sign off, you can enable it so that they can't actually accept the engagement without putting in either bank account details or credit card details to automatically facilitate direct debit in line with your credit terms, say 7 days after your invoice, 14 days after your invoice, and so on. And I think about best practice credit management and cash flow management, I think the advantages that this has is so many. So if we go to like kind of pre-engagement, it's kind of like the warning signs, right? So if they don't want to sign a direct debit and they may not have passed a CreditWatch check, you're kind of there going, what is it like? What discussion do we need to be having now? It's almost like one of the first signs that you might have with the client, right? If that's going to be an issue with them.
If you've got a client who doesn't want to sign your engagement and doesn't want to provide their payment details, and they don't have a really, really good reason, then you need to seriously consider if this is the right client for you and if you should be engaging with them at all in the first place. Yeah. The only circumstance that we accept to not put in payment details is we do some work with some charities that they can't do it. Like their constitution doesn't allow them to do these sorts of things. Or non-for-profits, and that's really the only circumstance. And even then, half of our NFPs actually put in their payment details now because they've made an exception for the accountants. So it's definitely a moment where you can find all those warning signs at the beginning.
Yeah, I think one of the other points I wrote about cash flow is that if you have a portion of your client base on direct debit, it's a lot easier to obviously then predict the cash flow point. So if you have, say, 50% or more, say like, obviously your aim is 100%, but say, 50, 80% on direct debit, you can say, all right, so on this date, every couple of weeks, every month, there's going to be this amount of money that drops. And it's so much easier to then plan, build your cash flow forecasts and budgets around that, right?
Absolutely. And, look, it's really important at any time for any business owners to understand what their cash flow looks like and when the money is going to come in to pay certain things. But particularly in, regardless of whether or not you're an advisory accounting business with monthly recurring revenue or something a little bit more compliance focused, most accounting and bookkeeping firms do have peak periods and we have low periods as well. So being able to have that certainty throughout the whole year of when cash is going to come in helps you make those decisions that you need to make around staffing or extra premises or whatever it is that you need to do to get through. Having that comfort around your cash is hugely important. And, and whether or not it's the actual cash or just understanding when your invoicing is going to be raised, which is, so if you don't have the direct debit feature turned on, for example, but you still need to have some clarity over what your income could look like, assuming that you end up with no bad debts and people always pay in terms, then the engagement process is really important for that as well, because it sets out what you're going to be doing when. And we all know as accountants, 99% of the things we do have got due dates. So we know when that service is going to be completed, and we know when we're going to get paid. We'll raise the invoice at the very least. And that all comes down to having a really effective and clear engagement process.
Yeah. Really.
Yeah. The engagement's also really important for being able to monitor your scope creep as well.
Correct. So, yeah. Lachlan, just quickly you said that the majority of a lot of your client base is on a subscription base. Is that all via direct debit as well?
Yeah, so we use Stripe, and the way we kind of do that is they're on direct debit, monthly direct debit for the membership, and then any additional work that we do, and we do that generally on fixed fees, just gets added to their kind of invoice at the end of the month, and that also gets taken out directly from Stripe. Yeah, so direct debit. Yeah, so I mean, one thing I would say with direct debit is the bigger the client, often bigger sort of enterprise clients won't obviously want to sign up to a direct debit, and in some ways you just kind of got to go with how they do things, because often they have like a procurement system that you've got to use. They might have 90-day payment terms and all that sort of thing, and so unfortunately, when you have the larger the client, I guess the more buying power they have, and they might not be willing to adhere to the kind of system that you're using. But certainly for the SMEs, the other thing we tend to do for a small medium business as a first time client that might be a small business, we'll ask for payment up front into a trust account, and we do that if we have less certainty that they're going to pay at the end of the engagement, and so we'll just require payment up front into trust. If you're a member, we don't, and that's another way of encouraging membership.
Beck, I've got to do it. We're going to do two things at the same time. So Beck, I'm going to just kind of round out your section with talking about using the current environment as a great time to be encouraging people to move on to direct debit and things like that, right? Using this as a platform for change. At the same time, we're kind of answering that. Lachlan, can you have a look at there's a question that's been asked in the Q&A. I think if you can pull that up, I think down the bottom, and I think that might be directed to you. And then after Beck answers, we'll jump back to you to answer that query. I think it's from Laura Stead, if you can see that one. All right, Beck. So using the current environment, so to use as a catalyst to change PracticeIgnition, are you seeing a pickup there?
But I think that's going to be a natural thing for any accountants in the way they engage with their clients at the moment, because that ability to work with them face to face or in more traditional sense has been taken away from us. So as you transition to the cloud and take your firm there, it's a easy peasy time now to plug in PracticeIgnition and move your engagements appropriately online. You're not going to be sitting around waiting to mail a client an engagement, get them to sign it off and send it back before starting work. And one of the things that's going on at the moment, particularly around JobKeeper applications, is there's an extra level of authority we almost need right now to be able to lodge these things on our clients' behalf. And there's a lot of requirements around JobKeeper in regards to, we're doing forecasting. So we have to make sure that it's the client who's taking responsibility for the forecasting and some of the information they're giving us to form parts of the information we have to give the ATO. The most effective way to make that happen is to put it in your engagement. The quickest way to make that happen is to do it electronically, get it signed off. And everything right now is really time sensitive. So this is a new way to engage with your clients, and absolutely should be something that you continue on. And not in regards to just the way that you send out your engagements for JobKeeper right now, but change the whole way you're working with your clients. Touch base with them more regularly, update your engagements, manage your scope, and make sure you get paid for all the work that you do. And that's what we're all here for, right?
Yeah, completely. I couldn't have said that myself. Thank you, Beck. Lachlan, were you able to have a chance to read that?
The question from Laura.
Yeah.
Sure. I mean, it's not so much a legal question. It's really, ultimately, with supplier terms, there's the terms that you're agreeing to in the contract, and then there's the, when you pay, right? just because you're delaying payment, just because the supplier says you're on 30-day payment terms, and if you pay it 60 days, what are they going to do? Depends very much on the supplier. If you think about larger suppliers, that right now there's a bunch of larger suppliers that are kind of going, all right, we'll accept extended payment terms. We're seeing that a lot with clients. And then in terms of on the client side, if you're saying 7-day payment terms and they're larger clients and they have their own kind of accounts payable department, then they're not going to pay in 7 days generally, even if your terms say that. And the reality is it just comes down to kind of negotiating and focusing more, and again, like focusing on more in terms of collections on the biggest invoices. And again, if you can get some kind of Stripe or PracticeIgnition or some kind of system that's getting automatic direct debit, then that kind of solves that issue for you. So I'd say like right now, this is generally across the board in terms of the legalities of all this. And again, we have a panelist who is all about helping with collecting debts, but the legalities are less important than the commercial reality of is there money to pay the invoice? And no one's really going to court over this sort of stuff now because people know that if there's no money, there's no money.
Got it. Thank you. We're moving kind of through towards the tail end of the journey and the engagement with the client. And I know ideally, we all hope that with our engagements and through all of our work mitigating risk by implementing good process through CreditorWatch, having great terms reviewed by LegalVision, and then delivering it efficiently with direct debit payment terms via PracticeIgnition, that this would be all mitigated. However, occasionally things still go bad and you need someone in your corner like Slater Byrne. So Liam, firstly, what can and can't debt recovery agencies do? I think it's probably the thing that most people are interested in.
Well, look, we are limited in terms of what we can do in contacting debtors. We're very well guided by the ACCC in terms of we basically can harass clients, debtors, no matter how many times we get asked to do so. Look, I think the best way that we find to recover a debt is very much by working with debtors, now more than ever, especially during the COVID pandemic situation. At the moment, we're very much encouraging things like deeds of settlement, payment arrangements, just to avoid having to go down the credit default route, the legal route, if at all possible. So at the moment, and generally our process involves just trying to work with people, trying to get them on the phone, speak to them, not just sending letters and issuing credit defaults. It's very much about trying to speak to these people and let them know that we're also here to help them in getting the debts paid. And it's we find that probably works best.
So in what you're saying, in your experience and across your firm's experience, how do the debts that get delivered to you, what are the common factors in successful recovery? Like, what are you seeing gives you the best chance of recovering for the client?
Definitely, as mentioned earlier, look, there's many things you can do. Having the correct set of terms and conditions is invaluable. It's so important. Having out your payment terms, sending them out so that people are aware exactly when the debt needs to be paid by.
Yeah.
And a massive asset as well is having a company like CreditorWatch, as Pat discussed earlier, just doing your credit checks on companies. Just check if there is a default previously, if there is legal action or a judgment out against this company. It doesn't mean you can't work with them, no, but I suppose the main thing then is limit the credit that you are willing to give them. Yeah. Give them tighter payment terms. Make sure that they do sign those terms and conditions.
Make sure they're on direct debit or something like that, right?
Yeah, even look, direct debit is obviously very important if you can get that. If you can't get that, my next advice would be to even try and get a personal guarantee. Look, they can be difficult to sign, but to get a director to sign. But I mean, look, terms and conditions are generally only used if the debt isn't paid. And if they're not willing to back their own company, then why should you back theirs? I think Beck mentioned earlier.
It's a good point.
Yeah, it is. It's why should you be the one that's putting your neck on the line for a company that you don't even know anything about apart from a credit check.
Does it sound tougher when an Irish person says something like that? I don't know.
You know, a lot of people do request that I make the phone calls.
Yeah.
But I don't know, maybe my accent's a little bit harsher. But no, look, again, we very much work from a point of view of trying to get people on the phone, try and speak to them, discuss that they're, I see McGregor there, from a different part of Ireland, Ryan. We very much try to work with them and just let them know that we are here to help them, as well as obviously help our clients get the debts paid. I think that's important.
Has anything changed now that, like, with legislative things about what you can and can't do in current COVID environment, or has anything changed recently?
From our point of view, probably not a lot. I've had a lot of clients, our own clients, contact myself because they generally have a direct number for me, just to make sure that they're taking care of everything, that they have the correct terms and conditions in place, just to make sure that they've all angles covered. There's not a lot of changes to our process. There has been changes to the legal process in terms of bankruptcies and stat demands. They generally, a stat demand and a bankruptcy notice expires after 21 days. At the moment, that's actually been extended to 6 months for both. So I think that's being reviewed in 6 months again. But at the moment, companies and individuals are just been given a little bit of extra time to try and set up payment arrangements to get the debts paid, which goes back to my earlier point of just for everybody, try to work with your clients at the moment. And, you know, I know it's tough, but giving them that little bit of fresh air, I'm sure they're in a few months' time when things pick back up, they'll remember the generosity at this point as well.
I think that's a kind of closing out with what we're discussing with you, is we discussed that having a relationship with a recovery agency such as yourself, you can have an ongoing relationship. Just because you're using, say, Slater, Byrne, Recoveries doesn't mean that it's the end of your client relationship. Right? Like the way you approach things, you can approach. You don't always come at things with a bat of of legalities. But you can approach things in a softer way, right?
Yes, and I think it's very important to do that. I don't think picking up the phone and screaming at somebody helps getting a situation resolved, no matter what line of work you're in.
Yes.
So that's sort of the approach we take, is very much to try and, as I said, resolve situations with people by treating them with decency. And as I said earlier, working with them is, it's going to benefit you in the long term as well. From our point of view, having a relationship with us, people call me all the time, not even to send the debt through, but just to have a chat. And that's the benefit of being a client. Sometimes it's the accent, sometimes it's the voice, but generally it's just get little bits of advice as to what they should do. And generally I'll just advise, give them a deadline. If they don't come back to you by this deadline, then maybe it's time to send it across because they're not taking it too seriously.
Great advice. Thank you very much. Sam from Moula, I think you've been very patient there. Thank you for hanging in there with us. But as the kind of the lender representative of us, what's the credit environment like now? Is there appetite to lend? Can people get money at the moment?
Yeah, look, people certainly can get money. I mean, the credit tap hasn't been switched off. Included in a lot of the stimulus is, the government support to keep the credit tap on. But, there's a number of factors we look at now that we might not have looked at in the past. And that touches on some of the things that we've spoken about. There's a number of factors we look at. We don't want it to end up with Liam. Sorry, Liam.
It's okay, mate.
Pat spoke about, credit files, more than ever, we won't accept any defaults or court judgments or any sort of adverse. Whereas in the past, we could have looked past that to say, okay, well, what was the reason behind the judgment, and trying to look at the circumstantial things around that. Whereas now it's a little bit more difficult. Lenders are a lot more cautious. We're looking at what the continuity plan is, because these aren't things we looked at before. I mean, how are you going to trade through this period? We'll ask that question. What is your plan? You see takeaway, restaurants pivoting to takeaway to try and keep earning that revenue. So industry is very important because obviously different industries have been impacted quite differently with the restrictions. some are actually flourishing. We have supermarkets approaching us because they can't keep it up. These are independent supermarkets. They can't keep up with the level of stock. So they actually want more cash just to keep the shelves packed because they can't handle the demand. On the flip side of that, you have hospitality businesses who've, suffered 80% loss in revenue, or a gym who's got no revenue. So, industry is very important, and how long they've been in that industry. One thing, what the advice I would have for a lot of businesses that want to obtain quota is to speak to their bookkeeper, speak to their accountant, because one of the number one issues we have is accounts that haven't been reconciled. So I mentioned in the intro that we use, cloud accounting data, and the amount of time that we're permissioned into cloud accounting data and the financial statements are all over the place. That the balance sheet doesn't balance, the bank balance is way out.
So that factors into your lending assessment.
Definitely. I mean, we are lending unsecured, so our number one or our only way out is the ability of the business to repay. So we want to work on live data and accurate financial data.
One of the things that I did in research was learn that Moula is named as one of only 5 non-bank lenders to participate in the government's SME Loan Guarantee. Can you tell us a little bit more about that?
Yeah, so, obviously as part of the government stimulus, they announced this SME Guarantee program. And what this program is basically a lender entering into a risk-sharing agreement with the government where they'll guarantee 50% of the loan amount in the event of a default. Any SME in Australia with turnover up to $50 million that intends on using these, the purpose of the fund, is for business use, is eligible. And what that does is really just ease the flow of credit because the government's willing to basically underwrite 50% of the debt. So that will, that's further eased the credit burden in terms of the access to the credit's made it a lot easier.
Yes. Okay. And one final question that we had here is, if a business already has a finance facility in place, but because of this, there's further cash gap because of COVID and the increasing pressure on current credit. They already have a finance facility in place. What are their options from there? Can they refinance? Like, what are you seeing in the market currently?
Look, refinance in a commercial sense is very difficult, especially if they're already in a default situation or have fallen behind in their current repayment schedule, because essentially another lender doesn't want to take on that onto their books.
Yes.
So it's up to them to work with their existing lender to try and come to an arrangement of part payment or a pause on payments. So it's really about working with your existing lender rather than refinancing out to a new. With the SME Guarantee program, it actually explicitly states that it can't be used to refinance existing debts. But because of the nature of the product, and I should have mentioned earlier, is that it's 6 months, no repayments. So for the first 6 months of the loan, interest is being capitalized, but there's no repayments being made. So that gives a business a bit of breathing room to trade through this difficult period. So that is an option. They could run that loan concurrently, and then hopefully we're out of this mess in 6 months, or revenues, back to a level where the business is a lot more viable and can continue to thrive in the future. They could run that loan concurrently.
Okay, got it. All right, thank you. Thanks, Sam. We've got about 1 minute left, so unless there's other questions, which please send them through now. I was going to do a quick wrap, and I'm not sure. I think it looks like my webcam might have frozen there, but it's all right. I'm still here. Pat, final takeaway from your perspective with CreditorWatch.
Look, I think being aware of who you're dealing with and getting as much information on your customers at the moment is extremely important. It's unprecedented times. I hate using that word because it's been overused, but it's a really good way to describe what we're going through at the moment. People talk about reading books and increasing your knowledge bank as much as possible. It's exactly what you should be doing with your customers at the moment, is just understand what sort of position they're in. Pick up the phone, run searches, whatever it is, just understand who they are, what they're doing, and how they're going.
Okay, thank you very much. That's great. Lachlan, final takeaway points.
Yeah, I think from my perspective, it's don't like right now. The commercial reality of what's going on is kind of more important than the legal ins and outs. So things that you would have done a few months ago from a legal perspective don't make sense to do now. So really be thinking about commercially what's going to help your business, but also your customers' business to survive over the next 6 months. Focus on that rather than what specific contracts say. And I think that's sort of the main message I'd have.
Great, thanks, Lachlan. Beck, you're on mute currently. Just
sorry, I forgot about that part. Look, no one really likes dealing with contracts that much. So if you want to make sure that the contracts are tight and you're engaged, use templated electronic services for your accounting and bookkeeping. There are certain things we should get signed off and certain authorities that we should always have in place. This just gets that awkward part of the relationship out of the way at the beginning so you don't have to deal with it later when it's too late, and secures your cash flow. Well, I mean, it makes total sense to me.
thanks, Beck. Liam.
Just if anybody's having any issues with bad debtors presently, just to try and get the details of the debt in writing. As I said earlier, it's a time to work with people to try and help them get out of this situation, and getting payment arrangements and things like that in writing, admission of the debt in writing or email. That would probably be your best option at present, and pick up the phone, speak to people, and
Well, I like your approach. Thank you. Sam.
Yeah, I mean, just everyone to know that the credit tap is still on, but just now more than ever to speak to bookkeeper, speak to your accountant, make sure everything's in order so that when you do apply, you have the best chance of approval. Because again, lenders are lending, they're just going to ask a few more questions than normal.
I appreciate that. And great advice. It's great advice from all. The theme that I picked up on was proactivity, that you can use all of your respective apps and services to be proactive and be on the front foot. And through that, you'll be able to maximize your chances of increasing credit and cash flow management, making that more efficient. I'd like to thank all the panelists for joining us. Thank you very much. I really appreciate all the time you put in, particularly before as well, and getting the content together. For everyone, the attendees, this has been recorded. We will we'll edit some things and put it out, and make sure if you want to watch it again, and if you want to pick out a few more things, listen to Liam's accent again, whatever it is, you can you'll be able to listen to that. So again, thank you very much, and until next time, we'll see you soon.
Thanks for having us, Noel.
Thanks, Matt.
Thanks, Noel.
Thank you.
Thanks, everyone.
cheers, Noel.
Bye.